Local and foreign invested companies doing business in the country are required by law to comply with Vietnam accounting standards when recording their financial transactions. Foreign companies may choose to manage two accounting records. One is based on the Vietnam accounting standards, and another compiled specifically for the overseas head office. Vietnam accounting standards requires that accounting records. The record must be in Vietnamese language. Must use Vietnamese dong as the accounting currency. The accounting records must comply with the Vietnam Chart of Accounts. The companies must include numerous reports specified by VAS regulations, printed on a monthly basis, signed by the General Director, and affixed with the company seal. Foreign companies wanting to use another currency for their financial records need to submit an application to the local managing tax office. This accounting currency unit must be one that is mainly used for the foreign company's banking transactions, services, and selling price quotations. The same foreign currency can also be used to account for revenues, employee salaries, and payment of material costs. Companies are advised to double-check their accounting system, taking care to spot possible Vietnam accounting standards non-compliance issues. Tax authorities can penalize companies for Vietnam accounting standards non-compliance through the disallowance of input value-added tax credits and withdrawal of corporate income tax incentives. Annual compliance. Prior to transferring profits, foreign companies must fulfill certain annual compliance requirements, involving a statutory audit, audited financial statements and tax finalization filings. Procedures are not only required by law, but are also a good opportunity to conduct an internal financial health check. Statutory audits in Vietnam are performed in accordance with the Vietnam standards on auditing. Audited financial statements and tax finalization filing must be done within 90 days from the end of each financial year. The following general guidelines apply to the retention of documents and other accounting records. Documents to be kept for at least 5 years include those used for management or operation of the enterprise. Documents to be kept for at least 10 years include accounting data, accounting books, financial statements, and reports of independent auditing firms. Documents to be kept permanently include those that are significant in terms of economics, national security, and defense. Under existing regulations, the annual financial statements of foreign investment enterprises, listed entities, business cooperation contracts, insurance companies, financial institutions, and state-owned enterprises are required to be audited by a duly licensed independent audit company. Audit contracts should be signed with the independent auditors no later than 30 days before the close of the entity's financial year in accordance with Decree 105/2004/NDCP dated March 30, 2004, and Law on Independent Auditing with effect from January 1, 2012.